Welcome for our Q&A on the CalHFA California Dream for All Shared Appreciation Loan Program. I think almost all of you know me. My name is Kimberly Bankston Lee, and I am a realtor with Guide Real Estate. And I have Tracy Gallardi from Delta Lending. We're really excited about this CalHFA program because it's going to provide somewhere around 3,000 or so families to get into homes this year, especially those who may be first-time homebuyers. And first-time homebuyer is the qualification for that is you haven't owned a home in the last 3 years. But Tracy will get into a little bit more detail in that. Tracy, I'm going to go ahead and give it to you, and I will advance the slides.
Oh, perfect. You can be my slide girl.
Yes.
Well, welcome, and thank you for taking a little bit out of your evening to chat with us. We were just talking about the fact that it's also the night that the basketball championships are on, but who cares? So my name is Tracy Gallardi, and I am a lender. I'm a local lender here in Sacramento. I have been in lending for a little over 30 years, and I work for a company called Delta Lending Group. And one of my passions in my entire career has been really, at the end of the day, it's all about getting homeowners into homes. And this new down payment assistance program is a really great tool to help our first-time homebuyers purchase a home in a market where we're seeing some affordability concerns. So California Housing Finance Agency is a local agency. They are downtown Sacramento, and they issue assistance programs to first-time homebuyers. They have a couple different programs that we have used in the past, but the one we're going to talk about today is the new California Dream. I want to go, ooh, the California Dream for All Shared Appreciation Program. But it's really designed to help buyers get into homes with some assistance towards your down payment and closing costs. Because ultimately, we find that a lot of times first-time homebuyers don't have the down payment or the closing costs to cover everything. You might have some monies of your own. You may have gift money from family, but this program is actually going to be set up to help us with a large down payment amount. So the way it works is it is a conventional mortgage. So there are different mortgage types. There's an FHA loan, if you've heard of that. That's backed by the Federal Housing Administration. There is a VA loan if you're a veteran, and then there's a conventional loan. And so this program is a conventional first mortgage with a second loan that will provide up to 20% of the sales price of the property or the value of the home towards your down payment and our closing costs. So that's pretty substantial and pretty hefty if you think about it. If you look at a home of $500,000, 20% is $100,000 that they would provide to you to cover your down payment. And when I talk about down payment and closing costs, when you buy a home, there's always a down payment amount. And then on top of that, there are lender, title, and escrow fees called closing costs. And so we can use that 20% to pay for just the down payment. And let's say you have money to pay for your closing costs, or we can use that 20% to kind of structure a lesser of a down payment and use some of those funds to cover your closing costs so that your out of pocket is pretty minimal. The other piece to the closing costs is that it can be paid for by seller credit. So as you're buying a home and you're negotiating your contract, there's the possibility that the seller might contribute towards your closing costs as well. But that's a pretty hefty, substantial amount of an assistance. There is no interest rate on the second mortgage. You're not having to make any payments on that second during the term of the mortgage, but you are making mortgage payments on your first loan. Okay, and we'll kind of explain that second in just a bit on how that works, but there are credit income limits, or I'll start with credit score requirements first of all. So there is a 660 minimum credit score or a 680 credit score. And the difference really is on what your annual income is. So when you buy a home in a certain area, there is what they call an area median income. And if you are at 80% or less of that number, then you would be able to qualify with a 660 credit score. If your income is 80% or more of the area median income, then you're sitting at a 680 minimum credit score. Credit scores are derived on a mortgage credit report. So we as a lender will pull a credit report for you. Each borrower on the loan has 3 scores. So we pull from all 3 bureaus. And then we look at the middle and the lower of the middle scores for the borrowers. So that may not make sense, but if we were buying together, Kimberly and I, we would pull Kimberly's credit scores and mine. We would look at the middle of each of ours, and then we take the lower of the 2 in qualifying. Anybody have any questions on that so far? Okay, if you do, just yell. But there is an overall credit or income limit for the county.
Oh, I have a question.
Yeah.
When you say middle, do you mean because there's 3 different credit bureaus? What do you mean middle?
Yeah, so there's 3 credit bureaus, right? There's Experian, TransUnion, and Equifax. So when we pull a credit report, each bureau reports a score. So we look at all 3 of them, and you take the middle of the 3.
Okay, I got it. Okay, thank you.
Perfect. Okay. So income limits for the county. So in Sacramento, El Dorado, and Placer County, our income limit is $202,000, which means that all of the borrowers on the loan combined cannot earn more than that. And that is a little bit of a different number than the area median income as well. So you might find that you're making close to that 202, but then you're going to be over the 80% of the area median income. And we do look on a map. There's a map of Sacramento and all of California, which this program is good for anywhere in California, not just Sacramento. And so we look at the income for the county and then the area median income to determine credit score requirements. These are for owner-occupied properties only, and they can be a single-family residence. They can be a condo. It can be what we call a PUD, or a property in a planned unit development, but it cannot be for a duplex or any sort of a property that has multiple units. So it really is a single-family residence, condo, PUD, 1 unit only, and they do have to be owner-occupied. We talked about a first-time home buyer briefly. So a first-time home buyer is truly someone who hasn't owned a property in the 3 years prior to an application. So if you've owned a home in the past and you've sold it and you haven't owned in the last 3 years, you actually are considered a first-time home buyer again, which is great news for people who owned property once upon a time and have sold it, and now they want to get back into the housing market. There are 2 homebuyer education classes that are associated with this program. They are provided by the California Housing Finance Agency. There are also some FHA, or actually HUD, Housing and Urban Development approved agencies that we can go to. One of the classes is pretty lengthy, but it goes over a budget, setting up budgets, setting up households, loan processes, and whatnot. And then the other class goes over the shared appreciation part of this program. So both of those classes are required.
They're online, right?
Oh, hi, I have a question.
Sure.
So for the first time home buyer, if you are a couple, a husband, wife, and let's say the husband has purchased a home within the last 3 years, but the wife has not. So would the wife qualify as a first-time home buyer, or is it a couple that they look at and then they would not be eligible?
Yeah, great question. So if we're using both of you to qualify for the loan, meaning we're using your income and your credit, then you both have to be first-time home buyers. If your spouse was a home buyer and you want to leave him or her off the new loan, which means you would qualify alone, then you could qualify as a first-time home buyer. And this program does not allow for any non-occupant co-borrowers as well. So anyone on the mortgage that's qualifying has to live in the property.
Got it.
Angel, You're actually, yeah, that's a great question. And Angel's right. She made a note in the comment section about ownership is classified if you were on the loan or only on the deed. If you're on the deed only and not on a mortgage, you're still considered a home buyer because you have interest in that home.
That was a good
Okay.
question.
That's a great
Thank you.
question.
Thank you.
You're welcome. Okay. So
And then-
let's,
I was just going to add the classes can be done online, right?
yes. So the classes can be done online. You can find one of the counseling centers to do in person. And actually I have a link to their online classes and some of the area institutions that will provide the classes. So we can share that.
And do you have to have the classes complete before you can go apply for this program?
Yeah, so the certificates that you get at the end of the counseling session are valid for a year. And you don't necessarily have to have them done at the same time that you're making offers on properties, but it might be good to go ahead and take those classes when you've got some time now, if you're interested in participating in this program.
And so that's making an assumption that you have to apply and get approved for this program first before you look for properties that you qualify for.
Yeah, so you can take the
Okay.
class at any time, right? The home buyer classes can be done at any time. But in order to qualify for the program, you do want to have a lender do a pre-qualification or pre-approval. So we need to make sure that you've met credit score. There's also a thing called a debt to income ratio. So they have a maximum of 45%. And so we want to make sure that you qualify for a conventional loan and for this program before you're out making offers on properties and before you're looking at homes. But you could do the home buying classes before that. Does that answer your question?
Yes.
Okay.
And is the credit score limits, the credit score, are those hard and fast numbers? Like if you're 659, then you don't qualify at the time that you submit your application?
They are very hard and fast numbers, yes. So if your middle credit score is less than the minimum required, then a loan officer's job is to work with you to figure out what we can do to your credit to affect perhaps an increase in your credit score. They call that a rapid rescore. So if there's things that can be done, like a balance paid down or an account closed, which don't ever close an account, but if there's things that we can do to your credit in the short term, we can look at those to perhaps change your score to qualify.
Thank you.
You're welcome. The debt to income ratio is really key in the fact that the way we calculate those is we take a proposed house payment plus your monthly liabilities. So anything that would show up on a credit report, like a car loan, a student loan debt, credit cards, anything like those payments, we're going to calculate, we're going to add that on top of the proposed monthly house payment. And then we divide that by your gross monthly income. And that gives us the debt to income ratio.
Tracy, why is there a range?
There is a range. If your scores are 700 or less, then you're maxed at a 45% back-end debt ratio. If you have a 700, well, so I should say 699. If you have a 700 plus credit score, then we can actually stretch that debt to income ratio to 50%.
And somebody asked me earlier, if you're making payments to the IRS for back taxes, is that part of your debt to income ratio?
Yeah, it would be considered a liability. And so we as a lender would want to see that you've been making payments to the IRS for at least the last 3 months. And then we would consider that payment in your qualifying, which also goes along the same lines as student loan debts. Now, I know a lot of people have them, and so they're currently in deferment by the government, but eventually, some point, they're going to come out of deferment and people will start to have to make payments on them again. So lenders and our institutions that underwrite and hold mortgages have said that the rules will be that we need to take a payment of that student loan balance to qualify. Normally, we would, as a lender, would take 1% of the balance if there's not a payment showing on the credit report. And so sometimes that might be a little bit higher than what someone might actually be paying on their student loan debts. So there's some things that we can talk about off today, but ultimately we'd probably have to take it out of deferment, which means that you'd have to start making payments on it again. But if it's a much lower payment, it might help in your qualifying. Student loans are fun right now. Okay, so let's move on to the next slide. All right. So the way this program works is they are providing you, it's not a gift, it is a second mortgage that is liened against the property. So you'll have a first mortgage and then you'll have a second mortgage for the amount of the down payment assistance. When you buy, or I should say, when you sell, refinance, or transfer ownership of your home, then the down payment amount that you borrowed, the 20%, is due and payable back to California Housing Finance Agency. And they are also going to share in your appreciation. So you're going to also have a smaller amount, or an amount that you would have to pay back on top of what you borrowed. The second is a 30-year term. It's for the same term as the first mortgage. You're not making any payments on it. So that's what we mean when payments are deferred. You can make payments on that amount if you wish. If you were to pay off the second down payment assistance amount, that actually triggers the repayment of the shared appreciation. So I had someone ask me last week, well, what if we pay it down to $1? You could actually, if you had the funds available, could pay back the down payment assistance monies and leave $1 on the balance, and it would not trigger the shared appreciation repayment.
How would they determine the share appreciation? Would they have to do an appraisal or?
Yes. So if the shared appreciation is triggered, or when you go to buy or sell, or refinance, right? We pull an appraisal of the home to determine the value of the property. So if you're not selling, but you've paid off that second, then CalHFA would send an appraiser out to estimate a value or provide a value of your property. So the repayment of the DPA and any shared appreciation is due when you transfer title. So if you were to transfer title to another family member, that would trigger the repayment. If you sell your home, if you pay off the first lien, that triggers repayment of the assistance. If you pay off in full the subordinate second, or if you refinance the home, that triggers repayment of the assistance and the shared appreciation. So we mentioned earlier that the assistance part has a 0% interest rate on it. And the interest rate on your first mortgage is actually set by California Housing Finance Agency as well. So Angel asks, what if the home has depreciation, right? So we're banking on home values increasing over time for two reasons. One, it builds equity in your property, right? So as you pay down your first mortgage and the value of your home increases, you build some equity in your house. The other reason we want to see appreciation is that when you do go to refinance or sell your home, that you've earned some appreciation on your property to earn equity in that range, if that makes some sense. If the home doesn't appreciate, then you still have to pay back the 20%, but you don't have to share in the appreciation of the home.
That's only if you trigger. So if you trigger the repayment?
Yes, if you, let's say your home doesn't appreciate, right? But you are going to sell the house and we haven't enough value in it, they will still require the payment of the second down payment assistance part, but they will not require the part of the shared appreciation. So what we have to do is we have to kind of look at it in two buckets. One is the amount that you borrow to cover your down payment and your closing costs. That's that 20% of the sales price or the appraised value at the time you buy your house. And then as you live in it and as time goes, you will gain appreciation. There's a shared appreciation part of the mortgage or of the loan that you also have to pay back. So on that next slide, there's an example of kind of what that looks like.
Tracy,
Yeah.
before we go into the example, I have a question. So going back to the shared appreciation, I have to admit, I'm a little concerned about that and sort of how it's calculated, because we all know that there is an inequity in the housing market when it comes to people of color and when they get appraisals on their home. So there was a whole report and special news thing that talked about how there was a $200,000 difference for a Black couple who was trying to sell their home. They got it appraised, and the appraiser basically knocked it down $200,000. Of course, they're trying to sell it for the top price because the comparable homes in that area, they knew something was wrong. So they ended up hiring 2 other appraisers to value their house, and found out that this particular appraiser and appraisal company traditionally downgrades homes of people of color when they're trying to sell it. So in the shared appreciation, it's really important to make sure you have the right numbers, because a person could be paying less or be paying more or not the proper amount, right? When they have to pay back the 20%, or when that 20% shared appreciation is triggered. So I'm not a mathematician, but I do know a lot about equity and inequities in the housing market. So can you just talk a little bit about how the FHA program is going to make sure that there are buffers or monitoring or equitable things that are going to be in place to make sure that it's fair across the board and there's no disparities with people of color?
A good point. So one of the things that in this program that they've stated is, so when you look at the appreciation that you have to share back with CalHFA, it's based on when you purchase the home and your income at the time you buy it. So if we are considered on the lower income spectrum, which means that we have a 660 credit score, our income is at 80% or below the area median income, then CalHFA will share in 15% of the equity, or I should say appreciation. If your income is over 80% of the area median income, then the home buyer is giving back 20% of the appreciation. So those numbers aren't going to change down the road. They will stay the same as the time when you secure the financing. Appraisers, whether it be that you are selling a home, you're refinancing a home, or you've triggered this repayment piece, they are all hired through what we call appraisal management companies. So the lenders don't have direct access to hiring an appraiser. We did way back in the day, but with the changes in government guidelines, they have made that somewhat more neutral, to where we just request an appraisal to be done. The appraisal management company hires an appraiser, and the appraiser goes out to the property. Now, every appraiser is a little different, and their opinion, it's really their opinion of value. It could be different from appraiser to appraiser. I've seen that happen before. CalHFA will actually order an appraisal or an appraiser through an appraisal management company. And it's not necessarily CalHFA actually requesting the appraisal, it's the lender that does it. So if you're buying or refinancing a home, then the lender would request the appraisal. If it's where you've maybe paid off that second and you've triggered the repayment and you're not refinancing or selling the home, then yes, CalHFA would have to request the appraiser. And they would do it in the same way that we do. It's done neutrally through a third party.
And the good thing
So-
about seeing those reports is you can see the comparable houses, and like you could always reach out to a realtor and get an opinion on a value too. I mean, we're not appraisers, but we do study the market and understand what homes are doing. You can ask for a second opinion on the appraised value. You can ask for an appraisal review if you feel like the appraisal is way off from what other similar homes have sold for. And you can also get an opinion from a realtor. But we have trainings on those, Tatis. Like, I know what you're talking about. There's a documentary on YouTube that I had to watch when I got my license or renewed my license. So it is something that the industry is aware of. And I'm glad that you brought that up, because it is something that we need to be taking a look at in different neighborhoods and different housing.
For sure.
Thanks for your answers and comments. Thank you.
Yeah, you're welcome. I wish we could just beat the appraiser into a value, but we cannot.
We've asked for reviews.
I will say that you can always rebut an appraisal report if you don't agree with the value that the appraiser has provided, that you could work with a real estate agent to come up with comparables in the marketplace that might help support the value. And we can always represent those back to the appraiser to see if there's any change in the value. Most of the time, lenders don't allow for a full second opinion of value, because then it looks as if we might be shopping for value. But if you really feel that the appraisal has some gross errors in it, then we certainly will take that up the ladder to the appraisal management company, to their reviewers, and provide additional information to potentially change or affect the value of the home. For sure.
That's really, really great to know. Thank you.
You're welcome. All right, so let's talk about the shared appreciation part, because again, there's two buckets. So it's the amount of the down payment assistance that you borrow. That is always due and payable back to CalHFA. But now what they're asking in this program is that as your appreciation grows in your property and you sell, refinance, or change ownership, they are going to share in whatever appreciation you have earned. It's not equity, it's just the appreciation. So if you bought a home for, let's say in our example, we're going to say $500,000. We borrowed 20% to affect a lower loan amount to $400,000. But now if we sell the house a few years later and the value goes up by $140,000, you take this $640,000 value or sales price at the time, subtract what the purchase price was when you purchased it, and that difference you're going to pay a portion on. So again, it goes back to your income at the time we did the loan. Let's just say in this example, I think this is the moderate income. When you're 80% or more of the area median income, you're going to share 20% of the appreciation. So if you take 20% of 140,000, that's 20, what is that again? 28,000. So you're paying back the 100 plus the 28. Does that make sense? Okay. It's kind of hard to explain sometimes, but it really is two different sort of things. And then if your income is 80% or less than the area median income, instead of the 20% of the shared appreciation, you're going to pay back 15% of that difference. So it's what you're selling the home for, or the value at the time that you're making a change in ownership or refinance or selling the home, versus what you bought it for. So I think that is.
Go ahead.
What are you going to say?
Oh, I was going to say something else.
Oh.
What I was going to say, I was going to go back to the depreciation question, because that is a big question. You know, the real estate market always has this ebb and flow, right?
Right.
Over time, we've seen a 3% increase, you know, in 50 years over time. But we tend to see this, right? It kind of goes down before it goes up. So participating in this program may mean that you need to stay in the home a little while longer. You know, you might have to stay in for 5 to 7 years in order to see that appreciation, because we have been on an increase for about, I think about 13 years. And so we started to see it come down a little bit in the fall, and now we're seeing a little bit of a blip of it coming back. But that's a long time to be going up. So some people think at some point it's going to go down a little bit, maybe not as far down as we were in 2008 or so. But this just means if you participate in this program, you might need to wait a little bit longer to get that appreciation in order to pay back that loan and have enough money to do whatever you want to do in the next home if you're going to buy another home.
Right. You do have to think about the equity piece. So here we have a home that is secured by 2 mortgages. There's the first mortgage that you're making payments on. And then there's the second mortgage, which is the down payment assistance portion that, let's say, you're not making any payments on. So that 20% is still the same balance as it was when you bought the home, but you've paid down your first mortgage substantially, let's say. So maybe as the values have leveled off a little bit, you might have gained a little bit of equity in the home. They're not necessarily sharing in that equity, but the equity would be used in order to pay off your existing first plus your second. Whatever's left might be the amount that covers the shared appreciation. And if there's any remaining, then that money would go to you as a profit. So I think it is sort of a long-term game in some cases, because values might level off a little bit. If we start to see them go up some again, that's great, because as your balance comes down on your first mortgage and your value goes up, you're building a little bit more room there to pay off these amounts. If the values do come down some, when you sell or refinance, you're paying back that 20% and whatever portion of that small appreciation you've made. And if there isn't any, all you're paying back is the original 20% down payment assistance. So it was created to really help people in our time right now to afford a property. And it is sort of their goal to be in home ownership. So that means you might be in this property for a few years, maybe not necessarily just a year or two. They do allow, which they haven't in the past. So mortgage interest rates have been on the rise, and they've been on the rise for the last couple years. Their interest rates on their programs are actually a little bit below fair market interest rates. And they are allowing for a one-time refinance after you've lived in the home and have made 12 payments, where they will actually subordinate the second or the down payment assistance and put it back in second position if rates do come down, so that homeowners can take effect of a lower interest rate. They don't normally do that. So I like that feature of this mortgage program, because we do anticipate that rates might come back down again in the next year. Probably not to wherever we saw them in 2020 and 2021, but we might be back down in the 5s or 4s versus being in the high 6s to 7s.
So can you have a first question. So shared appreciation is not the same as equity?
They are different. So the equity piece is, if you pay down your mortgage, you're building equity because now the balance versus the home is lower. The appreciation is only between what you originally bought the house for and what it's appraised at the time that you sell or refinance. So I hope that makes some sense.
That answer your question, Satis?
Yes, because I always thought of appreciation as equity in your home, but it's defined differently with this program.
It is, exactly.
So really because it's 2 different buckets that we're talking about. So
right.
Okay.
We would consider it normally that as the value of your home grows and you've paid down your balance, that difference is your equity, but they will share in only the part that is what you originally bought the house for versus the value at the time. So we're considering that the appreciation part. And you
Okay.
answer your question about multiple first-time home buyers. You can have multiple first-time home buyers on the program. You just all have to occupy the property. So that's their stipulation, is that you cannot have someone on the loan unless they live in the home.
So if there are 3 first-time home buyers that submit an application to be on the mortgage at this one property location, all 3 have to live in the home.
Yes, exactly.
And they have to meet the income requirements too, right?
Right. So was just going to say, so if let's say you had 3 buyers on an application, we're using all of their income, all of their debts, and all of their credit. So when we went back to that example of credit scores, we would pull credit for all of the applicants, look at everybody's middle score, and we would use the lowest of all of them. Which
So
could
don't
be,
apply with somebody with a low score.
so you're going to dump the person with the low score. Right. So having co-borrowers is great if they've got good income and if they have less debts and they have good credit scores.
Okay.
Yes. So we do have to look at that. And so in a, like a, let's say a spousal situation, if you've got 2 spouses buying and really only we need one income from one borrower and they have the better score and they can qualify on their own, then we can remove the spouse from the transaction. Now, California is a community property state. And so that means that the spouse that's not on the loan also has to sign off on their ownership of the property. So they would sign what we call a quitclaim deed or a grant deed at the time of closing, and they would come off of title and off of their ownership. They can be added back on later, but for the purpose of the loan, they would have to sign their right-of-way to owning the property. That could be tricky in some situations.
Yes, that could be a deal breaker.
Right. But we really want to make sure that everyone on the loan meets all of the program guidelines.
Right. Right.
These are good
Yes,
questions. Is there
that's a
any
good
other
question.
questions?
So let's see, I had a couple, we went over the last time in our class last week. So we talked about the fact that you don't have to make payments on the second. You can if you wish. So if you pay it off, then that triggers the appreciation part, right? So you can pay it down to a small balance and it won't trigger the payback. Tamara's question is, what if you stay in the home and pay off in 30 years? Upon first payoff, then you start to pay off the 20% appreciation. Yes. So if you're in your home for a really long time, let's say 20 or 30 years, and you pay off that first mortgage, that's going to trigger the payback of the second and the appreciation. So at some point, you might find that the value of your home is enough to where we could refinance you and pay off the first. We would pay off that down payment assistance. We would give back a share of the appreciation, and then you could live in the home another eon and not have to pay anybody back. So there's ways that we can work with that as a lender. Most of your loan officers are going to be your, it sounds really cheesy, but your lender for life, but we don't go anywhere. We are sticking around for a while. And so as we're helping you invest and grow wealth in real estate, we should be here to answer some of those questions down the road as well.
Oh, I have a question.
Yeah.
So, okay, let's say you were to transfer the home, maybe like, you know how people leave their property to their children or whatnot? So I have a question about the repayment of the loan. Is it like a monthly payment thing, or you have to have the full amount?
That's a great question. You would have to have the full amount. So if you changed ownership and you gave ownership to a family member, let's say, and you don't own the property anymore, it would trigger the repayment of the down payment assistance in full, plus the appreciation part. Good question.
And then Statista asked, how long is this program going to be available?
Well, good question. So one of the questions I had the other day was, can I get the money out of CalHFA and then go look for a house? And unfortunately, The way the program works is that you have to have an accepted offer on a property in order to make a reservation for the funds with California Housing Finance Agency. So it's not something you can reserve now and then wait to get that later. So it is something that we have to work through getting a pre-approval completed for a homeowner, making sure that we qualify for the program. And then you would go out looking for property. And once you have an accepted offer, then we can make that reservation with CalHFA. They have about $300 million worth of funds available for this program. Estimating that people take about 150,000 roughly for the down payment assistance part, that's probably about 2,000 applicants. So we're really not sure how long the funds will be available for. We're guesstimating 4 to 6 months. It could go quicker, it might go longer. And then the idea is that as people get into these homes and in a year or two from now, and they do get out, right, then that money recirculates back through the California Housing Finance Agency, and then that can be used to help someone else purchase a property.
Now, Tracy, you don't have to use the full 20%, or you can use the 20% to put down like maybe 15% and have 5% for closing costs. You do that with these funds?
Yeah, we were sort of talking about that this morning in an office meeting about like, do I take the full 20? Do I take 10%? What do I do? And I think, in my personal opinion, it would probably be smart just to take the whole amount. And we can use that in a couple different ways. So it can be used to do a whole 20% down on a mortgage, which reduces your loan amount and reduces your monthly payment. You can put 15% towards your down payment, and then maybe use the rest of the 5% to cover some closing costs. So we did an example for a gal today at $350,000 purchase price. We were able to do a 15% down payment and then use portion of that to cover her closing costs. And she was actually coming in with less than a couple $1,000s. The 20% is kind of key because on a conventional loan, if you put 20% down, then you don't have what we call mortgage insurance in your payment. But if you're doing 15%, then you have a little slight amount for mortgage insurance. It's not much. So depending on how we structure that, that's what we would do together, is figure what is the best execution of this down payment assistance. I just want to look up. So one of the questions that Statis has is, what are the rates today? So really good question, because interest rates are going to fluctuate every day. So they move with the movement in the bond market, and they can sometimes move during the day. And so CalHFA actually posts their own interest rates for their mortgages. They're not as volatile as our normal, I can't even think of the word, volatile as our normal traditional mortgages. So they don't move as much, but they do change. And so the interest rate on their programs today are anywhere between 6 1/8 and 6 1/4, which is on the lower side compared to what we might find on a traditional conventional loan. Nicole's question about closing costs, what can you kind of estimate for closing costs? I always tell people that you're roughly estimating anywhere between 2 and 2.5% of the sales price of the home for closing costs. And we give you a ballpark when we do our pre-quals and our qualifications, mostly because we don't know who the title company is going to be in your transaction, right? So when you get into contract, there's a title company or an escrow company that's selected, and their costs are dependent upon the amount you're borrowing and per title company. So we kind of give you a ballpark idea, and then when you're in contract, we'll actually be able to get more accurate closing costs. And then
Denise is asking, are they fixed? These rates are fixed, yes.
Yeah, you guys have some great questions. Yes, the interest rates are a fixed rate mortgage. So what that means is that when you close on your home and we close on the mortgage, that interest rate is set for the life of the loan. It won't change. Now, when you look at a mortgage payment, though, a mortgage payment has a couple different pieces. It's the principal and interest that you're borrowing against so it's the loan amount over the years of the term and the interest rate. And then you have homeowners insurance, property taxes, maybe mortgage insurance. And if you're buying in a property that might have HOA dues, you'll have HOA dues. So the pieces of your monthly payment that can fluctuate a little bit are going to be the taxes and the insurance and the HOA dues, for sure, right? Because those things kind of change as the county might reassess your home, and maybe the property taxes fluctuate some, or if your homeowner's insurance changes, those things will affect your payment. But your principal and interest will only be affected by how much you pay towards your principal. Your rate will not change. That was a lot of finance jargon. But if you guys have questions on that, or if anybody has questions on that, I'm happy to go over that again on a one-on-one and maybe a little slower.
Thank you. Any other questions before you? Next steps is just what Tracy said. If you have, you want to do a personalized consultation, you would meet with her. Sometimes we meet together, but basically you would meet with Tracy. She gets you started, and then we work together. We're a team, and figure out what we can do for you. And then once we get a pre-approved, then I start showing you homes in your price range and meeting your criteria, and we just kind of go from there. Hi, Alexis. I saw you join us. I'm not sure when. I hope you were able to get the gist of this. How long does it take for pre-approval?
Well, so it's all dependent on how quickly you can gather all your information. There is an application that we complete. It asks for your employment history. We look for 2 years. We ask for housing history for the last 2 years. We run your credit. We look at your pay stubs and your W-2s or tax returns, depending on how you're paid. So depending on how all of that comes together, then it usually takes us probably 48 hours afterwards to get a pre-approval together for you. They are valid for 90 days, or unless something drastically changes within your credit profile. And if we're not in contract on the 60th day, then it's possible that when you do get into contract on a property, that we would just update the credit report or update the information.
This has really been a brilliant presentation. Thank you.
Thank you. That's nice to hear. I talk a little fast. I love that. Thank you.
Tell Governor Gavin Newsom, thank you.
Right. You're welcome.
Thank you. Great. Well, if nobody has any other questions, I know Kimberly and I really appreciate your time. And we love to share the information and educate people on what's going on in our marketplaces. And so if you have real estate questions that you want to know about, she's definitely your girl. And she's really great to work with. And so we together would love to help you.
Yeah. So jot down our information. You may have it already.